Hi, I'm Pattu from FreeFinCal. In today's video, let's talk about 6 stocks that have dominated the Nifty 50 over the last 10 years. We're going to look at the Nifty Bees, Nippon India Nifty Bees portfolio for the last 10 years to find out how the top stocks have changed weight in the Nifty 50. So the 6 stocks that repeatedly figure in the top 5 of the Nifty are Reliance Industries, HDFC Bank, Infosys, ICICI Bank, ITC and HDFC. And out of the 119 months studied between October 2010 to September 2020, the number of times each of these stocks have figured in the top 5 of Nifty is shown below. Reliance leads with 104, HDFC 91, Infosys 109, ICICI Bank 74, ITC 98. HDFC actually beats Reliance a little bit by 110. HDFC is very interesting. It has never been the top stock of Nifty, whereas Reliance has been the top stock of Nifty for many months. HDFC Bank has been the top stock for many months, but HDFC, the finance corporation, has not been the top stock not even once in the last 10 years, but it has been a constant presence in the top 5, 110 out of 119 times. That's awesome stability as a stock. There's no, I think that's a very good valuation metric, if you call it, in terms of how good the company is, not the price, but how good the company is, because the market has held it in a very high esteem. Of course, going forward, nobody knows, but at least in the last 10 years, that's the situation. If you look at the historical weights of these stocks, Reliance Industries has gone from 10% in 2010, it's gone all the way down to about 4% in end of 2014. After the bull run started, it moved up, and it's not looked back. It's actually almost 15% weight in the Nifty, which is the highest if you look for pretty much any stock. HDFC was the highest just a few months ago at 11%. It's all-time high, I think, and then it has dropped. Infosys has been up and down 9% in 2010, but always been lower than that, but heavily fluctuating. ICICI Bank 7.5, always below 7.5, 7ish% and so on. Again fluctuating. ITC, quite a linear trend. It shot up from 5% to 10% in from 2010 to end 2012, and has been all the way down since then. People are calling this a value buy. If you are in it for the dividends, you should be reasonably happy, but if you're in it for the returns of the price movement, then you might find it frustrating. Now the finance corporation, the Housing Development Finance Corporation, has been up from 5% all the way to about 9ish% towards the end of last year, early 2020, and then it's dropped a bit down. So the biggest problem is, if you take the total weight of the top 5 Nifty stocks and plot it, you can see that from late 2018 onwards, the top 5 weight has been at an all-time high for the past decade, and it's well above the previous high now currently, and that's the reason why you are visibly able to see active mutual funds struggle against the Nifty. Before that, you had to look carefully to understand that active mutual funds struggled against the Nifty. That is, only half the category members did well consistently. But today, the outperformance, the poor outperformance, or the lack of outperformance, I should say, is quite visible, and that is the reason why there is a lot of talk about index funds. My opinion is that many people who want to invest in index funds are doing so because of the recent past performance, not because for the right reasons. The right reason is, if you will invest in one active fund today, and tomorrow it will go from 5 stars to 3 stars, and you have to worry about it. If you invest in index funds, you don't have to worry about such things. So that's the right reason. But I don't think the current interest in index funds is for the right reason. This concentration high, there's not much you can do about it. I don't see there any reason to worry about it. But when the market homogenizes, that is when other segments of the Nifty top 100 start moving up, then returns of the Nifty may be relatively lower. For example, Nifty next 50 may beat the Nifty 50, like we had mentioned yesterday. Sometimes it might not, who knows. What is most interesting is in the last 10 years, only 61 stocks have been part of the 50 stock index if you take the actual number of distinct stocks. So that's a very low churn, and that's why it's quite stable, and that's why it should be the core part of your equity portfolio, whether you are doing direct equity, active mutual funds, large cap funds, hybrid, whatever. The Nifty stocks should be part of your core equity. Basically, most of Sensex, the top few Nifty stocks would also be part of the Sensex. So that's the reason why you need that kind of stability in your portfolio. So if you need this 10-year the 10-year portfolio history of the Nifty Bs for your personal use, contact me and I'll try and facilitate that. Catch you later. Bye bye.